All right. Happy Wednesday. Welcome to Live at 5, the educated home buyer, where the goal of this channel is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. With me, my esteemed guest, Josh Lewis. Josh, welcome back, buddy.
I'm moving up in the world. I'm esteemed now. It only took a year, but I've reached that plateau.
Bro, there's only so many adjectives you can use that YouTube wouldn't ban me for, and that was one of them. So I went with that one. But yeah, welcome to the world of real estate. For those of you who are new to us, we use this 2 hours, people, to help educate you, answer your questions on real estate and financing. Josh is our resident mortgage expert. I'll be playing the role of the real estate professional. So throw your questions in the chat. We'll definitely get to them. But before we get into that, let's talk a little bit about what's happening in the market over the last week. So we've had obviously some big issues or some big news rather overseas with regards to Russia and the Ukraine. We're going to talk about that and its impact on interest rates. Jerome Powell has recently come out and essentially assured the markets, if you will, that they are going to or that he is going to, the Fed rather is going to raise short-term interest rates, the Fed funds rate here momentarily in the next couple of weeks when they do their Fed funds meeting, in 2 weeks on the 15th and 16th. So hopefully that gives the market a little bit of stability, something to build off of, because we've had a volatile market, Josh, a lot of craziness out there. But people want to know about rates. They want to know where the market's headed. So let's spend a little bit of time here and talk about what we've seen, because I think a little bit of it, probably a lot of the viewers out there probably have no idea that rates actually improved considerably, but we're seeing a little bit of a retracement. I understand.
Well, let's talk about where most consumers get their information from. Up until very recently, the last year or two, when a couple of clickbait lead aggregators have figured out how to manipulate online headlines, the primary thing is every Thursday, Freddie Mac issues the primary mortgage market survey, and it tells you for the last 7 days, the preceding 7 days, the average rate and points that they were purchasing loans at. So it's a little bit dated. It's already 7 days out of date, and the media doesn't really focus on the amount of points paid there, but people will look at it and go, that's the rate. So because it's a lagging indicator, what we get a lot of the time is you will see interest rates have gone up that week, and we get a report that rates hit all-time lows. Well, they actually popped up 0.1%. Or the opposite, rates spike on bad news, and they actually have dropped the last couple of days. So it's not a perfect indicator, but it's the one that's most commonly cited in the media, so consumers often see that. But in terms of looking at where are we at right now and why has a lot happened since that last primary mortgage market survey last Thursday, we saw numbers coming out that rates had improved a little bit, but on Monday and Tuesday, actually Friday of last week when Russia invaded, then Monday and Tuesday, a lot of follow through. We saw a move in interest rates. Here, let's just go ahead and pull this up. These three big green candles
And
are
explain
moves.
what people are looking at, Josh, so we're all clear
Yep.
here.
So these three big green candles tell you where the market opened and then where it closed. And the red ones, it opened and then closed lower. So lower doesn't mean lower in interest rates. It means lower in bond prices, higher in rates. So we want to see these green candles in general. So give you a picture of what all this is. This was December, where we were in this nice range, rates right around plus or minus 3%. And then the new year ticks over, and we see almost all red candles. Tried to improve, went a little sideways, and then more red candles, including this big one.
But
And
Josh, I want to
yeah,
interrupt 1 second here. Tell people what are we looking at though? We're not looking at the 10-year. We're looking at mortgage-backed securities, which
these
are
are mortgage-backed securities. So when loans get closed and sold into the secondary markets in the big bonds, pools of bonds, not your one loan, but thousands of loans go into a pool. So this is Fannie Mae and Freddie Mac loans here on mortgage-backed securities.
got it.
So really all this is a way of looking at market sentiment and psychology and what's going on here. So what you see here is we're trading sideways, and we're almost at the bottom of this range. Friday, the war breaks out. Russia invades, and you see it go to the top of the range. Nothing really improved over the weekend, actually got worse. So the market jumps up a bunch more. Again, another day jumps up a bunch more. That's a huge move to have happen in 3 days. And a few clients that I'm talking to that you guys have questions every week. Hey, I'm closing in 3 months. Should I lock on my new construction? A couple of those clients that were having that conversation was, hey, as long as we stay above this blue line here, we can float and try and get closer to your closing date. And what we were saying is our best case is that we would get to this red line here. Without boring you with what that is, we thought that was our best case. So to give you an idea, geopolitics, war, crazy things, terrorist attacks, things like that will kind of throw these charts out of whack. So we got in 3 days what we were hoping to maybe get over a period of a couple of weeks. And then today we come back in before anyone really gets the news that interest rates had improved. So to tell you, this is from here to here was about 3/8% improvement in interest rates in 3 days. That's big. An eighth percent on Monday or
Yeah,
on
so that
Friday.
means if you're 4%, that's 3.625%. I mean, that's a big change.
Yep, a big change. And then we come in today and we're thinking, well, that red line is kind of important. It wouldn't surprise me if we drop back below it. Well, we drop back below it hard. And you always try to look and go, what are the factors that moved it? Well, it isn't like there was peace breaking out in the Ukraine and that which what we were thinking. Hey, if they have peace talks and they stop bombing, then maybe we see this. Well, what happened? We had the State of the Union last night, and the markets were hoping that Biden would say, hey, this crazy quest to kill U.S. oil and natural gas and pushing our gas prices and inflation higher, that in light of what's happening in Russia and that we bring in 600 billion barrels of oil from them, that maybe we'll stop that and try and control some things and put pressure on Russia that way. He
Not
didn't
today,
do that.
sucker.
Yeah, he did not do that. So overnight, the markets are like, well, that's not good because that tells us energy prices are probably going to spike and could lead to longer inflation. Then this morning, Powell had to speak before Congress, and he basically said, at least he said, we're going to raise a 1/4%. I'm going to suggest that we raise a 1/4%. He's not telling you, but he's basically telling you they're not going to raise a 0.5%. And a lot of you are saying, why would you want them to raise a 0.5%? The reason why rates spiked so quickly so fast is the markets lost confidence in the Fed, that they had lost the plot and they were letting inflation get too high too fast. So the markets just said, cool, if inflation is going to be that high, we want higher yields to reward us for that. So paradoxically, when the Fed hikes rates, which they only control short-term rates, they don't control the 10-year, they don't directly control mortgage-backed securities, but once they start hiking and letting the markets know, hey, we're serious about this, we're going to work to get inflation under control, that's going to be better for interest rates. You know, if you follow in here every week, I do not believe we're in some long-term trend of high inflation, higher interest rates. This could be another 6 months, it could be another year, it could be another 2 years, especially with the uncertainty of the war situation and how much just global supply chain chaos we're going to have, depending on how long this goes, the level of sanctions. So we talk here every week that we don't have a crystal ball, but we're looking at all of the news and trying to take our best educated guess on what comes next. Right now is harder than ever. So the only reason of showing you this here is we get 3/8 in 3 days and we give back a 1/4 of it. So basically, rates are about an 1/8% better than they were last week. And if we were to guess, a lot of you are going to ask, hey, I'm in under contract or I just signed a contract on a new purchase. Should I lock? Best guess is we trade sideways here in a new slightly better range here, an eighth better than it was last week. There's a lot of risk. There's potential it could get better. There's more risk to the downside. So if we say, are we advising lock or float? Unless you're someone that's a gambler and you're going to watch this every day and stay in communication with your loan officer, it's a market where you just lock and stay the heck away from this, because with the geopolitics stuff, it's not easy to predict what comes next. I mean, things could get much worse and we could see rates drop. Things could get much better and we could see them get worse, or things could get worse in terms of the war situation over there. But then that leads to cutting off of
Fed.
supply chains and
Well,
inflation,
yeah,
or like Jeb said, the Fed backs out and says, hey, we're gonna sit out for now.
yeah. If
There's
that
like 50.
happens, you will have hoped that you had locked. Yeah, if the war in Russia gets, I mean, really gets bad, and the Fed sees, big problems, they could take that off the table. Now, I would hope that that doesn't happen, but if they did, you would see so much volatility in the market. Rates would spike. It would create big turmoil with regards to to the market. I mean, to the stock market, the interest rates, the whole thing. So, if you like it, there's people out there that use the quote: "If you like it, lock it." It takes the risk off the table. I think that's the motto at the moment to live by. Just because there is volatility in the market.
And the issue is that at some point in the future, I don't know if that's 6 months, 18 months, 36 months from now, you're going to get an opportunity to have lower rates and refinance. So if you get a rate that's manageable, you qualify, you can handle the payment, lock it in, take the risk of it getting worse off the table, and then we can look in the future when things improve for an opportunity to improve your rate and payment.
Okay, good stuff. So at the beginning of the show, I didn't mention. So Josh, many of you guys. So obviously my YouTube channel, but we have Josh on here every single week. Josh and I, because we have a lot of really good conversations off air in more depth, we thought, hey, we'll take it to a podcast to give people, a really more granular view of some of the topics that we touch on very lightly here. And so we started a podcast, The Educated Homebuyer. You guys helped name it. We're on Apple, we're on Spotify, we're on podcast, Pocket Cast, all of that stuff, right? So go search it. But the reason I bring that up is because next week's episode, so we're going to upload on Tuesdays. That episode is going to touch on what's actually driving home prices. So a lot of you guys wonder, why are home prices continuing to rise? We go deep level on that. And then one of our better episodes, I think, where we really talk about it is should you buy a house in 2022, what that actually looks like. And so if you go back, search that episode, check it out. In fact, I had a shirt made. Look at this, guys. I had a shirt made.
He's a fashion model.
I'm looking. Look at that. So check that out. Yeah, it's a plug, but hey, good. It's good information, guys. It's free information to help you become a better home buyer, and that it really is the whole goal of this thing. Josh and I don't dedicate 2 hours every single week because we need to learn housing. It's for you guys to become better home buyers, better home sellers, better investors, whatever it is. So just want to say thanks for the support on that one. There's the episode. So check that out. Josh, let's talk a minute here about inventory. Inventory been a huge driver of why, we talked about interest rates. The other key driver is supply and demand. I every week update you guys on my local market. Today we sit at 1,329 properties in Orange County. That's the highest that I've reported on a weekly basis to you guys in quite some time. So we're up about 60, 70 properties since last week when I said that. I think we were at like 1,260 or 1,270, somewhere in there. So no, not a big change, but it's increasing. That's a positive. Here locally in Huntington Beach, 100 today. That number's been fluctuating. I've seen it as high as a 120, and I've seen it in the 90s here recently. So 100, it's, we had 8 new properties come on the market today, and we're sitting at 100. So properties are coming on the market. They're just selling very, very quickly. In fact, the story, went to a listing appointment, talking to the home buyer, had the listing, but I was there helping them move out. It's here locally it's actually in Westminster, but it's right on the border of Huntington Beach, right across from Golden West College, anybody that knows the area. And they have to move all the furniture out. It's the homeowner has moved out of the property, and we're basically helping them get the property sold. So I'm there talking to the gentleman who is going to be facilitating it, literally get a knock on the door, the next door neighbor. I want to buy the house. And she basically says, look, I own the house next door. I own a house across the street. I will buy the house today. That is what you're competing against at the moment. She doesn't even know the price, right? She doesn't know the condition. She knows nothing, but yet she's a home buyer. And you might say, well, she might change her mind when she finds it out. I'll tell you, probably not. That's the competition in the market at the moment. And it's local, right? So real estate is local. Depending on where you're located, it might be a little bit different. So just make sure you're following the trend out there. Our home, is the number of homes coming on the market, is it rising, or are they coming on and going off? What's happening with demand? I mean, as we can see nationwide, demand hasn't really changed very much. If you read the headline, yeah, the median home price might be down, buyer demand might be down, but why is it down, right? I mean, I recently did a video. Inventory in the luxury sector is down. Active inventory is down 50%. but buyer demand's only down 11%. So if you looked at buyer demand, you said, well, it's down 11%. Nobody must be buying them. Well, there's 50% less properties to choose from on that side. So you got to know all the facts. And that's what this show's about, is helping you get there. So, Josh, anything you want to get to before we start diving into um,
Lots of
questions?
talk about beards and herringbones, but we've been there, done that. So we're not going there tonight, kids.
I mean, we should talk more about herringbone. I should probably get a herringbone. It would go well with my black shirt. It would match the logo.
There you
Look at
go.
that.
If you do that, Jeb, I'm going to bring back my Bulls starter jacket and my big Dookie gold
Dude.
chain and my filas, my black and red filas.
Oh, I had an Oakland Athletics. Meanwhile, I lived in North Carolina,
North
so
Carolina,
lived in
wearing your
Eastern
Oakland
North Carolina,
Athletics.
small town, Podunk, 20,000 people. But I had an Oakland Athletics starter jacket. You know why? Because of the Bash Brothers, Canseco, McGuire. It was around 89. It was rocking that thing hard.
Roided it up with your
And had a athletic starter hat too. It matched. In fact, there's a picture of me and my two cousins. One of them has a Bulls get up like that on, athletics, and the other one Miami Hurricanes. We had it covered.
Picks, or it didn't happen.
And there were some mullets out the back. I could probably find one. Anyhow, appreciate you guys being here. There's a lot of regulars in here. We appreciate that. Jennifer Lego, our house moderator, ass kicker, if you will, is closing on her house on Friday. So big congrats to Jen on getting that step and making it happen. So she is adulting, which is fantastic. And so big congrats to you. Last thing before we dive into questions, Josh isn't going to be here next week. So boo for, all of you guys out there that are looking for Josh. Not going to be here. He's got better things to do. So my question to you guys as viewers, who people show up here every week, who do you want to see fill his spot? Because I'm not going to sit here for 2 hours and talk. First, I would have no voice. It would be awful for you guys to experience that. So I'd love to know who you want to see, and I'll reach out to him and see if I can make that happen. All right, Josh, here we go. Let's talk about, we're going to skip around a little bit tonight because a lot of questions we haven't been getting to because of there's been so many. Do we actually have any questions, or is it all comments? Al Bundy is asking, are many people renting out their house and not reporting the rent payments as income? So I see a lot of rentals. I see a lot of people keeping property these days. The smart people, if they can, are keeping real estate. Whether or not they're reporting that income is hard to say. Josh, what do you see? I mean, I'm sure you're talking to borrowers who are, have rental property and say, hey, well, I'm renting it out. Are they reporting it on their tax returns or not? What do you see?
Beyond the issue of right and wrong, what you run into is if you're not declaring it, if you need it to qualify for a mortgage in the future, refinance or purchasing another property, if you don't have it on your tax returns, it doesn't exist. So you can hide it from the IRS, but you're then also hiding it from a lender and either going to get some type of non-QM loan in the future with worse terms or not get a loan at all. So for the most part, all of our clients are declaring it. You're able to, once you convert it to a rental, you can depreciate the structure value over 27 and a half years. That offsets some of that. You're going to write off all of your expenses, property taxes, homeowners insurance, maintenance, anything that you spend. And most of our clients get pretty creative with the expenses that they have against their rental home. So when someone first moves out of their home, and I think actually, Al, you had the question, how does it work to qualify buying a new home and converting your current home to a rental? So if you move out of that property, we don't have a history on the tax returns showing what vacancy, maintenance, expenses were on the property. So what they're going to do is they're going to give you, the underwriter is going to give you 75% of the market rents. So it has to be a reasonable number, but 75% of market rents less the principal, interest, taxes, insurance, and association dues, if any. So as an example, if you have a $2,000 house payment and you can rent the house out for $2,000, the underwriter is going to take 75% of the $2,000, give you $1,500, and you have a $2,000 payment. So it's treated like a $500 negative. No different than if you had a $500 car payment in terms of qualifying for that property. Now, If it was the opposite and it came out to a $500 positive, we add that into your income and it improves the debt to income ratio. So that's how it works on a departing residence when we don't have the history. If you have a history of that property being a rental, they're going to analyze the last 2 years tax returns and see what your average income was net of expenses and your principal, interest, taxes, and insurance.
Good stuff. Josh, suffering sucks, and it definitely does. As someone who went to the ER last night with the 3-year-old that was suffering at the moment until we got there.
Until you got there, then he was no longer
And then it
suffering.
sucks. So nothing serious. Croup, cough, nasty stuff. Came home, was fine, but yeah, suffering sucks. So what do you do with your cash in this environment? Inflation's rising, stock market somewhat questionable, real estate prices are going crazy. Do you sit on cash, Josh? It's essentially losing value by the day, but what do you think? What's the plan?
I'm not against it right now, despite the fact that you can look and say, oh, inflation's eating away at the value. There's nowhere that I'm super comfortable. If I come across a property that I'm comfortable with investing in, I mean, I'm assuming that suffering isn't looking at buying a home. Buying a home is a way to do it. You're taking yourself from a renter into owning a home, but assume you already own a home. Buying additional real estate, it would need to be the right deal that makes sense from a cash flow perspective. So we talked about, the hedge funds. Let's say you had $300,000. Would you sit it in cash, or would you go buy a house cash for $300,000 and bring in $1,700-1,800 a month in rent? I like that. I'm comfortable with it. There's a reason why the big hedge funds are still doing it. Stock market scares me. Bonds, we just looked at that bond chart. Looks like they're going to trade sideways. They could get much better. They could get much worse. Not a bet that I love right now. Just not a lot of clarity in the world. So other than those options, and if we're talking like $10,000, I don't know that there's anything that I'm super comfortable to get into over the long term. And we had a little talk here earlier on about crypto. If it's not money that you need and you're depending on it and you're comfortable with the volatility and it's not a huge portion of your net worth, we talk about a lot of millennials and they have $20,000 to their name and it's all in crypto. That's crazy. But if you're 40 and you have $200,000 to your name and you have $10 or $20,000 in crypto, it's a reasonable investment. And not in terms of, for those of you that look and say, well, Bitcoin is just digital currency. Well, that's correct. It doesn't have a use. But things like Ethereum and the underlying businesses built on Ethereum, these are real businesses. So that doesn't mean they're going to pan out. It doesn't mean they're not going to go to zero, but it's reasonable to make some bets on that stuff with a small portion of your net worth. Jeb, you've dabbled in options before in a volatile market like we have right now. You can play with collared options and minimize your downside risk, but you probably should know what you're doing.
Let me give you my best advice. I am someone that owns equities. Most of my money is in equities. Not at the moment, but a lot of it is. Equities, I'm saying stocks. And I look for growth stocks. I look for stocks that move. I'm okay with some risk. I'm okay with big gains and big losses to some extent, just because I have a longer term time horizon. I'm less worried about what happens tomorrow or next year. I don't really follow it that closely. I don't say I don't follow. I follow it that closely. I just don't get concerned with that sort of movement. But with that said, options, listen, you've got to have big pelotas to go that direction and have zero emotion. We talk about people buying emotionally, justifying logically. You start playing options, you've got to have it's a zero sum game. Unless you do some of the collared stuff and you have it, you can get hammered. And I've made a lot of money and I've lost a lot of money. So at the moment,
people get greedy.
I haven't traded options in a long time. Ever since I became married and I had a family and kids, and it was no longer just my money on the line. It was a family deal. I stopped with the craziness because, there were days where I made $50,000 and there's a day where I lost $50,000. It was that volatile back then. So, I buy stocks now. I hold them, and I might, do some selling calls or selling puts or whatever on a stock that I own. But outside of that, I'm not an option man these days.
You
So
you could
anyway.
always tell how well Jeb's trading day went by the number of herringbones on at the end of the night.
Good stuff.
Hey,
All
Jeb,
right.
you
Let's
got
see.
you got a couple super chats in
Yeah,
here.
we
Why
do.
don't
That's
we
what we're
call
going
it
to hit
on?
up here. So Lonnie gave us $5. Thank you, Lonnie. Sorry for taking so long to get here, man. Let's see. What about the 6% they're saying you have to pay to list your home? The seller has to pay all the fees now. Don't the buyer's agent work against the seller? That just seems excessive. So I'm probably going to get hate mail for this, but I would say as a seller in this market, you're not paying 6% in most cases, not in Southern California, at least, right? I mean, you're not having to do you're not having, when people sell homes and they're charging 6%, there's typically, because there's an expense associated with that 6%. There's marketing, there's flyers, there's, whatever it is to help generate exposure for that property. In this market, because of the lack of supply, there's less of that necessary. So I would say I haven't done a 6% listing in this market, and I haven't even tried because I don't feel like it's necessary to charge those fees when things sell this quickly. My skills in this market are used on the negotiating, are used on helping, get the buyer over the hurdle with regards to repairs or whatever it is. Now, to go on to your question about doesn't the buyer's agent work against the seller? Yes and no. You can have that mindset or that view that the buyer's agent is your enemy and you guys are working against each other. The wrong approach, in my opinion. I look at it as, hey, listen, me and the buyer's agent are a team working to get to the finish line. He's looking to get the best deal for his client. I'm looking to get the best deal for my client, assuming I'm the listing agent in this case. And together, we are going to figure out a negotiation that works for everyone. Now, what I can say is by paying a higher commission on some of these things to a buyer's agent, the buyer's agent is more willing to forego some of this stuff. Maybe they're willing to use a portion of their commission if they're making a 3% commission in this case on a buyer side. They might be willing to say, you know what, the seller's not willing to do it. They've got multiple offers. They've got leverage. We don't really have a leg to stand on over here. They're not going to do it. You know what? In order to keep this deal moving forward, I'll give a portion of my commission to make this deal work. And that makes things move along, versus having to go back to the market, relist, lose time, so on and so forth. So in some cases, I always try to get the buyer's agent more commission than myself as a listing agent, because the buyer's agent is one of the more important pieces of the puzzle in many ways. But no, you're a team, especially in this. And with that, I would say the lender is also part of that team. So all together, collectively, you're going towards the finish line. So hopefully that makes sense. But yeah, in this market, you can negotiate more than others. But I will tell you, at some point, it won't be a seller's market. It'll be more of a buyer's market, and those commissions will be worth every dollar you pay in order to get your home sold when there's multiple listings out there and supply, competing against you. So thank you again, Terrence. $20 super chat. Huge. Thank you there, Terrence. Closed today. Been listening since December. Thanks for the great advice. Appreciate it, man. That's the one thing that's awesome about what Josh and I do, or, my videos in general, is that we get good news, positive news like this, and able to help people. So congrats. It's a testament in this market that you've been able to get to the finish line. So huge kudos to you. Josh, seeing anything there you want to throw up here? I'm just kind
Here's
of.
an interesting thought. Benjamin Fajardo says,
Yep.
one rental at a time has recently been saying we don't have an inventory problem, but a demand problem. What do you think, Jeb? Do we not have an inventory problem? Do we have a lot of inventory out there and just so many people that the massive amounts of inventory we have aren't enough for them?
Mike's a smart guy. At One Reel at a Time, does a good channel. He's probably not talking about Southern California when he talks about that in general. Do we have a demand problem? We absolutely have a demand problem, but it's being accentuated. I mean, it's being accelerated, accentuated, however you want to put it, because of the lack of supply. If there was more supply, the demand wouldn't seem so crazy, because there would be more options and less overbidding, less multiple offers, less craziness. If there's 5 properties in a neighborhood and there's 5 buyers, each buyer essentially has a property and they don't have to bid against each other and overbid in order to get those properties. But if there's one property and 5 buyers, guess what? That's where the demand gets crazy because everybody wants the same thing. And I'm using 5 buyers. Maybe there's 20, maybe there's 50. And you're going, nah, how can there be 50 buyers? Trust me, I'm seeing it all day long, writing offers for buyers and getting the response back from the agent. Oh, we had 52 offers on this property. I'm like, listen, I don't in any way envy what you're having to go through at the moment. So I don't necessarily agree with the statement there, but I get kind of what I think you're trying to say in that statement. But in some markets, maybe there is, a surplus of homes, and inventory is not the problem, but demand is still a problem. It's kind of a double-edged sword, in how you look at it. But both are accurate. And when I say demand is a problem, inventory is also a problem. So they're both problems in my opinion.
Jeb,
Josh, you want to add on that?
yeah, use your example of 5 homes on the market, 5 buyers available. So normal market, healthy, you say everyone gets a home. Not only that, one of those homes is going to be a lot nicer than the others, and it's
Yep.
going to sell at a premium because 2 or 3 of those people are going to bid against each other. So you're like, okay, I get it. That was a bitchin' house, so it sold for more. 2 or 3 of those houses will be really average, and the buyers will be like, well, I like that school district, I'll take that one, and I can paint it so it's not a flaming orange anymore. And another one will go, well, it doesn't have a pool like we like, but I can put a pool in, I'll take that one. Or that one has a pool, it's average but it has a pool, I'll take it, whatever. And then the one guy is going to go, that house over there is ugly and no one wants it, and I can make a low ball offer and get it. So everyone gets what they want. All of the homes kind of sell where they should. The crappy one goes at a discount, the average ones get a market price, and the nice one gets a little bit of a premium. In the current market, every house is a nice one. They all get a premium. The crappiest house on the block gets a premium because there's still buyers that are like, I don't want to go bid with 90 people on the bitchin' house. I'm going to go bid with 10 people on this crappy house. The end result is the same. They still pay a premium for it. So the demand is the problem, but it's not a problem if there is more supply. And we talk about this all the time. All real estate is local. Supply may not be a problem in your market. For us in Southern California, for most markets in warm southern states, whether that's, anywhere, any warm southern state,
Floribama.
even though they have land to build, the building is not keeping pace. So we have a very tiny number of homes. So like right now in Southern California, home sales are down versus last year. You see the headlines say, oh, home sales drop. And there's no homes for the people to buy. We got plenty of people to buy them. There's no homes for them to buy. That's a supply problem. The prices are getting pushed by demand, but the problem is that there's not enough supply. So it's chicken or the egg, and I'm sure it's more nuanced in his description of it if we were to watch the videos, but it all starts with supply.
No, good stuff. Here's a comment, and then I have some good follow up on this. So D says I had 46 offers on my mediocre home in Phoenix. So if you guys heard me chat before, I have a good friend in Phoenix market that sells real estate, top agent there. He sends me something called the Cromford Report, which is essentially their local market statistics. I'm going to read you the top of what is in the comments, of what he sent me, which is essentially astounding to some extent. I mean, these numbers are just stupid. But February 27th, let's see here. It basically says it is an increase of $11,246 in a single week, a rise of more than 2% in 7 days. Talking about the Phoenix metro market there. They burst through the $550,000 barrier just 18 weeks after bursting through the $500,000 barrier. The $450,000 barrier was exceeded exactly 1 year ago. So in a year, home prices are up $100,000 in that market. So do the math, 550,000, it was 450. It's up 25% in a year. The $400,000 barrier was exceeded in August 2020. The $350,000 barrier was exceeded way back in June of 2007, just as everyone realized the bubble had already burst. So, wow. I mean, I mean, they're seeing a 2% gain in market price in a week. That's nuts. And so if you're in Phoenix metro area, you know what that market's doing. So again, we talk about inventory, we talk about supply and demand, we talk about all of these things. Know your market. That's what's important. It doesn't matter what's happening in Southern California if you're looking at buying in Phoenix. I mean, it's important to know the general macro view of housing, but it's really good to know more of the microcosm of what you're of where you're trying to purchase, because that will ultimately get you the details you need. So I sent that to Josh too, and I think his response back was that's stupid or something along those lines.
No, it's
So
just it's crazy, and part of it, you got to be very careful with small sample sizes. 1 week is a small sample size, but it's an
correct.
incredible number, and it is supported by what we've been seeing so far year to date, despite the higher interest rates. And Jeb, we have someone who was asking, is 4.25 a good interest rate in California? No way of knowing. If it's an FHA loan, it's a terrible interest rate. If it's a 20% down investment loan, it could be a great interest rate. There's about 40 different factors that go into a rate. If we're talking just vanilla conventional loan right now, we talk regularly about the Optimal Blue Mortgage Market Index. They're at 3.98, but that probably doesn't reflect everything that was locked today with about a 0.25% higher rate. So 4.25 is right in the range, anywhere from 4.25 for your conventional loans with a decent qualified borrower, not a low credit score, not a super low down payment, but it's a moving target. Ask again tomorrow, so it's very hard to say. And along those lines, Jeb, the thing I'd like to point out, talk to borrowers all the time that will say, okay, I'm just trying to get some different quotes. So I have 3 quotes and I wanted to get one more. Can you tell me what your interest rate is? Say, okay, when did you talk to the other people? Well, I talked to one guy yesterday, and I talked to one last Friday, and I talked to one a couple weeks ago. Say, well, you don't have 3 quotes because you didn't get them on the same day. This stuff moves and changes all the time. So if you're a shopper and you want to call around and get the best interest rates, get quotes, you need to do it on the same day. And if the person's not asking you the questions that we just went through, in terms of what's your credit score, how much money are you putting down, what type of property is it, a lot of people, when you're calling, they're going to tell you the absolute best interest rate, and then they'll find out the details later once you start applying. So there's definitely a method to inquiring to make sure you get accurate numbers and apples to apples so that you can compare one lender to the next. And I will always tell everyone, do not select a lender off of rate. Rates need to be competitive, and all reasonable lenders should be in a really narrow range on what their rates and fees are. From that perspective, we usually come into the low end of that range, but I tell people that's not the important part. You need an expert on your side. We get questions and calls every day. I told Jeb I came in this morning with an all caps urgent subject line in my email inbox. Someone needed to talk, and we've talked to him 3 times already, and he's actually in escrow on a property, and we find out that in escrow went with the lowest bidder on the interest rate, and they're having some problems with it. And that's a pretty common thing that we get. So again, it's never to say don't shop. It's never to say that interest rate isn't important. It's far from the most important thing. Go with the person that you feel is listening to you, answering the right questions, and has the knowledge and expertise to guide you through the process to a successful closing so you don't have big headaches.
All right. This is the point in the show where I ask you to hit the thumbs up. If you find any value at all, you can go subscribe to the podcast, follow the podcast, get more information there. As I mentioned before, that is not the same content that we post here. It is a more in-depth view of specific topics. So if you want to get that, go hit that. We post every Tuesday, but more importantly, the thumbs up helps us get seen on YouTube, helps their algorithms, helps more people see it, which helps us get to more people and help them. So thank you for doing that. Let's see here. Anya says, did you see Russia raise mortgage rates to over 13%? I didn't see mortgage rates, but I did see that they raised their what they call their Fed funds rate or whatever their rate is, whatever they're calling it over there. I forget the name of it, but to 20%, which, because their currency is essentially getting hammered. And so that's their hedge from, I think, being just slaughtered at the end of the day. But yeah, not surprised. They got to do things to stay afloat. And that's the approach at the moment. Robert is Jeb must be staying strong with his goal. So far, man, no drinks as of yet in 2022. It might end. It might end tonight. I don't know. Might end any day. It's close to the end.
Are we going to Joe's when we're done? We went to Joe's last week. I tried to get him to get a picture of 805. And no, the beard's that important to me. I'm not going to have some 805.
I might actually have a drink and keep the beard at this point. The beard is taking on a life of its own. I might have to, just go with it. Let's see.
His wife stopped having anything to do with him physically when it was about this length, so he just said, "I've gotten used to it. It's not a big deal. I'm going to go."
Yeah, there's no concerns anymore. John Doe, probably the best comment ever, says, "My son and I are moving to OC from rural North Carolina. I hope it's Kinston." It's probably a friend of mine making this comment. Do you know any good local jewelers? My son's upper lip is starting to fill in, and I need to get him into a herringbone before school starts. So classic. So if you guys don't know, I am a redneck at heart. I grew up in Eastern North Carolina, and I used to have a herringbone and a really thin mustache, and I used to rock it. Just so you know, there's pictures out there to support it, guys. If you're looking for them, I can find them and post them. Jeremy says, "Hey, y'all from Fort Wayne, Indiana." Probably doesn't talk like that. But I just, coming out of North Carolina, I thought I would.
South last I checked.
I am an investor. Random market look from my view. Small multifamily inventory is up as rates slide up slowly. Investors trying to exit while others can enter. Single family homes still fire. So, yeah. So it's funny. I'm actually looking at real estate in that market at the moment. In fact, talking to a buddy of mine who sells real estate there, looking at it daily. I get emails daily of homes in that area. So if you are looking at Fort Wayne, let me know. I can connect you with a great agent in that state that can take care of you. But that's where I'm looking at putting my money. Suffering, ask Suffering Savage. Suffering Sucks, ask earlier where money should go. I'm looking at buying a couple of investment properties, something that cash flows. Yeah, can't buy it here in California with the down payments that are required in order for it to make sense. So I'm looking out of state, and that is one of the places I'm looking. So, but I don't know about the multifamily. I do know single family homes there are selling at a pretty good premium, but really cheap in the big picture, in my opinion. Let's see here. What do you see, Josh? See anything to click on?
Here. So Richard Rivera says, been hearing people at open houses opt for less down to cover appraisal gaps. Do you worry about the effects this could have on buyers, specifically 20% down to come out with 5 to 10% equity? And the important thing to remember here is the appraisal does not dictate the value of the home. Had a conversation with the realtor today where an appraiser brought in a value egregiously low, and she had done all the research and was probably correct. And it probably needed to come in a little bit low just because there weren't comps to support it all the way. So putting 20% down because an appraisal came in low doesn't mean you only have 5 to 10% equity. Your comp just set the market. The next sale will come behind that and be higher than that. Appraisals in a rapidly appreciating market have a very difficult time of keeping pace with the market, but it is not the arbiter of how much equity you have in your home at any given time. The arbiter of what is the level of equity is when you actually put it on the market and someone comes and offers you X amount of dollars for the home.
Good stuff. Jason is in Ontario, Canada, says that sold 2 weeks ago with 25 homes available. Today is 146 for sale. Now it's 1 to 2 offers per home. So yeah. So when you had 25 homes, there were probably 10 offers or whatever the number is. Now there's 1 or 2. So yeah, I don't know much about Ontario or Canada in general, other than home prices are, are way higher than they are here in the U.S. for most of Canada. So
I'd like to see the stats, Jeb. A 6x increase in the supply of homes in 2 weeks would be an astounding number in any
for sure.
market.
But they have weather issues there. Obviously, right? It's cold.
They froze everyone's bank accounts. They don't have money to buy.
Yeah, there you go. Yeah, so it's interesting. Again, real estate's local, so if you're in that market, it might be a little bit different. Let's go with this one. So we got some people saying, Jennifer Lego should. Yeah, Jennifer should fill in for Josh. That would be awesome. Hey, it's an offer. It's an option. Jen Beeston or Kyle. So earlier I asked, Josh isn't going to be here next week. Who should fill in? who should take Josh's shoes? And maybe we just axe Josh altogether. Maybe they're that good. We don't know. So we have them.
Clear up my Wednesday night so I can have Wing Wednesday from 5 to 10 p.m. instead of from
There
8
you
to 10.
go. Ahmed also says Jason Walter. Jason could be a good one too. I don't know if I've had him on a night show at all. But we need a lender. We kind of need somebody with the loan side, because I don't want to be talking about loans the entire time, especially with my, my lack of updated knowledge. All my knowledge is old school. Terrence, thank you again. I just wanted to click on that because I like that he gave us $20.
Jeb, you should do an old school mortgage episode, and you can tell everyone how to do 80/20s, 228s, 580 FICO, 100% financing. Just go through and tell them how it's all done.
Dude, I don't have any videos like that because I wasn't doing video at all, like in the mortgage side of business. But I do still have some original videos that we shot on the housing market. I should play one of those things. It is awful. Like, I can't even watch it. I mean, I think I suck now, but I watch some of those things. I'm like, oh my God, like, what did people think when they saw that guy? I'm still wondering that, but even more so back then. So if you guys can sit through one of those one night, I'll play a portion of it and you guys can just laugh. You can drink beer and laugh and throw things at the screen. It'll be hilarious.
They'll say Josh's cinematography was just money, though.
Good stuff. Let's see. Somebody asked earlier about investment rates, Josh. So in this market, it's always best to have a conversation with an actual lender, right? Run your scenario by a lender, have them look at your credit, have them look at your pace, go through the pre-approval process. But say you don't want to do that. Say I don't want to go through that process. I just want to know what rates are. Where do people find interest rates? We've talked about optimal blue, but how does somebody find rates on like investment property in this environment?
When I saw the question, I was like, that's actually a good one, because I don't know anywhere that publishes them.
Trying to
And
find the
here's
question.
here's
Give
the
them credit.
problem. Here's the problem with it, is that depending on how much you're putting down, the loan level price adjustments can vary a ton. The type of property can vary a ton in where that rate. So it's hard to say. Like, I could quote someone 4% on an investment property today. I had a good client, well qualified, 800 credit score, and the scenario she was trying to accomplish, it was 4.875 today. So it's a pretty wide range of what's possible. We used to sit and say, well, it's a 1.5 adjustment for non-owner occupied, so it makes it about 0.3% higher in the interest rate. And then Fannie and Freddie got real cute with their LLPAs and made a much wider range. You have to put a lot more down to get to that level. So it's a tough one. I don't have a good answer for it. I think Jeb's answer was the best. Talk to a mortgage professional and have them run through and quote you the numbers.
Of course you do. Of course you do. Grace says, hey, Jeb, Josh, thanks for all the education you both have provided. Close tomorrow. Took 11 months. So it took 11 months because there was new construction involved. Got connected to a great agent up in the Bay Area, a friend of mine. So this is the point in the show where I say, if you need to get connected to a great real estate agent, a great lender anywhere in the country, you can just click that little link. You can't click it, actually. You have to go to the website, and I can connect you with somebody, and that takes great care of you. So congrats, Grace. I know it's a long time coming, but well-deserved, and good stuff. Good stuff for you.
If we're in the pat ourselves on the back section of the show, we also
Well,
have
we're not
another
there
one here.
yet. That comes about an hour from now.
No,
Let's go.
you're already in the middle of it. Dippa 1965 says, just hit the like button. Appreciate all the wisdom, knowledge you gentlemen offer. This information this time last year helped my wife and I during our home search.
There you go. So awesome, good stuff.
I have another quick, easy one
we
here.
talked about that one. We did that one. Okay, go ahead.
Andy just asked, what would a good rate be for FHA? Best qualified FHA borrower is going to be right about 3.5 right now. Less well qualified, 640 or below credit score could be as high as 3.875.
All right, good stuff. Justine, do you guys think an offer with an FHA loan can still get accepted in SoCal? Any advice on how to make an FHA loan offer stronger? Yes, it can definitely still get accepted. Is it going to be easy? The answer is probably not. But they do happen. So don't just think you're out of the market because you have an FHA. You've got to it's probably better that you obviously need to be fully pre-approved. If there's a position for you to be fully underwritten without a property address, that might be an option that you go through as well, so that you can show somebody that you've been through, the full process, and that you're not just pre-approved, so to speak, that you've actually been underwritten by a lender, right? I don't really say that very often, but I think that's something one step further you can take. Make sure your agent is including your mortgage professional, your mortgage expert on any contact with the other side, so that they can follow up and say, hey, listen, my client's FHA, but understand we've been fully underwritten. They're good to go. They have money for an appraisal gap if there is or not or whatever. Just, obviously don't give them information that isn't good to support your offer. But if there is information there, like you have extra cash to cover something or you're doing something, mention that stuff. I will tell you, as a listing agent, I want to work with other great listing agents, other great mortgage professionals on the other side. It's not always about the guy that puts 20% down or the girl that puts 50% down or whatever. It's about, who can get to the finish line. I don't care if you put, 90% down if you're going to be a pain to work with, if you have no idea what's going on. And ultimately it's not my decision, but it's a conversation I'm having with the seller saying, listen, this person's following up, this person's doing this person's checking all the boxes, these are the things we need to consider, and putting that in front of the seller and let them make a decision. I often stress FHA loans have the most flexibility with regards to guidelines. They do. A 57% debt to income ratio in some cases, much higher than the 44-45% that conventional is going to require. So yes, it's possible. Just make sure you got pros surrounding you with regards to those offers.
And Jeb, that's actually really good advice, to go through and get it fully underwritten. I mean, I know that if I have approved someone, that it's 100% going to close, but most times we are in a huge market. Every listing agent we're working with on a transaction or submitting an offer to, it's generally the first time I've ever met or been introduced to them. So they don't know me. They don't know to trust me.
They
So
don't know me. They don't know me.
you don't know me. So the best way we can do that is to put that in writing and show that it's been fully through underwriting. At that point, the only concern they should have is FHA and VA buyers also generally have less funds available in terms of wiggle room to work with a low appraisal. So if they have a 50% down or a cash offer with no appraisal contingency, it's going to be hard to overcome that. But we say this every week. I don't get upset when I have a buyer that can only qualify FHA. We get them in 8 days a week. It's not easy. It takes time. You got to do a little extra. But again, just to circle back, Jeb's 100% correct. I have a VA buyer right now. She's gold plated. We didn't need to, but we put it into underwriting and got the full underwriting approval to submit with her offers.
Good stuff. Good stuff. Got some, like, Katie's asking me if my client should buy a two attached home on a single lot, one protected, one family with kid. I don't understand, but as the professional, the expert, that's the advice or the information you should be passing along to your client. If you're reaching out to me with somebody that doesn't know the area, then probably not. If it's not obvious from where you are, then it's probably not the best decision for your client. Hard to say without knowing up front, but that's what you got to look at. Unfortunately, I don't know. You go on to say the list price is 1.9, front home and 3K rent. Back home is 2.7. So 3K rent on a $1.9 million purchase doesn't seem like a good idea to me, unless they absolutely have nowhere else to put their money. Even it bringing in $5,700 with both of them on a $1.9 million doesn't seem like a great rent. Yeah, I mean, I can get, my house isn't 1.9 million, but I could probably bring in 4,500, maybe $5,000 a month in rent off my property. And, so yeah, I don't, that number doesn't sound great, but yeah, anyway, that's what you got to do that work.
The mortgage qualifying can be difficult on that also, depending on the zoning. If it's not a duplex and it's a single family, having that guest house or an ADU, a lot of lenders, especially in the jumbo space, get real squirrely about using rents to qualify from the second unit if it's not truly a duplex.
Good stuff. We got two good questions here, Josh. I'm going to post. Maybe two that we haven't actually heard. If I apply for an ARM loan, do I need to qualify for the payment now and also the payment in the future when it adjusts? So, Josh, let's talk about what an ARM is, an adjustable rate. What does that actually mean? And how does a lender qualify you to see if you're capable of actually getting that type of loan?
So a true adjustable rate is going to adjust month after month after month. As soon as you get the loan, every month you get your statement, you go, hey, what's my rate? What's my payment? Very few of those are done except for very high net worth individuals. The more common option is fixed for a period of time, generally 3, 5, 7, or 10 years, and then switches to an adjustable after that. It's cool in that it gives you the ability to give yourself some certainty for the period of time that you're likely to own the home, but at a slightly lower interest rate than the 30-year fixed. And these are generally portfolio loans. Lenders are offering them on Fannie Freddie products, but the rates generally, there's not enough of a discount to make it make sense. So to answer your question, under the qualified mortgage guidelines, anything fixed for 5 years or less, you have to qualify at a fully indexed rate. It's been so long, honestly, since I've done one. I don't know the exact terminology of the guidelines, but fully indexed meaning it's like 2% over the start rate or fully indexed. It's in the guidelines for each program. But if you're fixed for 3 years or 5 years, yes, you're going to have to qualify for higher than what the monthly payment is. For that reason, the 7-year ARM fixed for 7 years and the 10-year are more common because those just qualify at the start rate and you don't have to qualify for a payment above and beyond.
Good stuff. I like it. Good information. Dressalonga, what counts as a comp when they're pulled? A specific mile radius, a time range from the sold date. So, in where we are, suburban area, there's homes, in tracks all over the place, right? So what appraisers in this market are typically using as a comparable is they'll go back 180 days. Typically, they want to stay within, I think, and I might be misquoting a little bit, so appraisers don't reach out to me and send me hate mail here. Ideally, they want to be as close to today's date as possible. Those are better comps. Most appraisers can go back 6 months and still use a comp from them. You can go back a year and make time adjustments if there's not comparable properties in some cases. And in some markets right now, because of the lack of properties selling, you might have to go back there in that time. But typically speaking, 190 days to 180 days is really the most they want to see. They try to find properties that are similar in bedroom and bathroom counts in a general area, 1 mile radius of the property. Now that's here for Southern California. The closer to that property, the more, we have a lot of tract housing here. So a lot of times you can find a model match to a property. Those are even better, especially if they've sold recently, because you get a good idea. So those are really what comps are. Now, if you're in rural North Carolina, where I'm from, you might have to go 3 miles out to find a comparable property because it's different. It's not tract housing. A lot of homes have been, custom built. Yard sizes are different. Some have acres to go along with it. So there's a lot of factors that factor in what a comp is depending on where you're located. Rural is a completely different animal. I honestly have no real way to help anyone justify a value in those markets because I've never sold real estate in those. But here in Southern California, that's what a comp is. And in some cases, you have to, in this market, if you're using a comp that sold, let's say it closed today. Today's March 2nd. Let's just say it closed at the end of February, just for purposes of doing this. So it closed at the end of February, and it sold for, say, $50,000 higher than the asking price. What you have to realize is that property actually went into escrow 30 days prior to that. So if you're doing time adjustments on that, you actually have to factor in that difference in time in how the market's appreciating. Now, appraisers can't go in and just say, hey, the market's doing this, or hey, we've received 20 offers on this property, therefore the value is this. They're compensating factors in how an appraiser gets there, but the appraiser still has to justify that value using comparables and make adjustments, right? So sometimes there's positive adjustments to the subject property. Sometimes there's adjustments where they take away value on that subject property because of other factors that it didn't have compared to comparable property. So I know that's a lot of information, but that's kind of the gist of it. But I'll say one more time. Now, I'm not an appraiser. So appraisers, that's a general scope. I don't need hate mail or comments here telling me that I have no idea what I'm talking about.
And it is, Jeb, it is super easy to
It's
beat up on.
subjective too. So just
It,
keep that in mind. Five
it's
appraisers might come up with five different values.
They
So just
will.
not, yeah.
And it's complex and it's easy to beat up on appraisers. And Jeb and I were having a conversation earlier today about the appraisal that we were discussing that came in low. And there is a specific type of appraiser that brings these values in low, and it's almost like they're the older get off my lawn guy. And they're generally really good appraisers. When we get an appraisal, I can look at it and you can generally tell the quality of the appraiser. The ones that are coming in low are not the ones coming in from crappy appraisers. They're the ones coming in from someone who's pretty darn good at their job and is convinced that they know the value better than the market. But don't want to bash on appraisers. It's a very difficult job. Jeb just did a really good job explaining all of the things that go into it, and he probably didn't even scratch half of the surface if we brought an appraiser on here to explain it to us.
Yeah. I mean, as somebody who has had the opportunity to sell a lot of REOs, foreclosed properties over the years, we had to do something called a BMA, like a broker's market analysis of a property. So we do a very condensed version of what an appraisal is. We have to look at comps, we have to make adjustments, we have to do certain things in order to give the bank back then an idea of what the value is. And even today, I'm an agent that I'm able to sell relocation properties. So when somebody relocates out of Southern California, maybe to another state, I might have an opportunity to interview for that listing. In those cases, I also have to do BMAs. And so I'm familiar with the process, but nowhere near what an appraiser, the detail that an appraiser would actually go through in that process. So again, Josh said it best. I'm scratching the surface in this sort of thing. So, but that should give you a pretty good idea of the process. Here's one, Josh. St. Nick. St. Nick says, I wish y'all would talk more. Y'all. I haven't said y'all in a long time. Talk more about the pre-approval or the approval process for people wanting to relocate to a different state. I'm talking about people wanting to find new jobs in their destination state. So actually, if you go to the podcast, we actually talk about the approval process. And what's important here is the approval process doesn't change regardless of the state that you're going to. It's the same process. You're going to go through the same steps in the approval process. The only difference is that maybe you've got to use a lender that's licensed in the state that you're looking to purchase. So if you're here in California and you're looking to buy in Tennessee, you need a lender that's licensed in Tennessee, not California, and vice versa. And sometimes you'll find a lender that's licensed in both California and Tennessee. Some are licensed in all 50 or whatever, but the process doesn't change. You still have to provide the same documentation, the same stuff, all of that information in order to get pre-approved. But if you want a detailed look at that, Tuesday's episode, we dive into it deep, go through the pre-approval process. So check that out.
The big question he's asking there, Jeb,
Yep.
is talking about people who have to find new jobs in their destination state. We have to have employment. We can't just say, hey, you made $100,000 in Wisconsin, so you'll make $100,000 in California. You can have an offer letter if there's certain verbiage in there. So at risk of sounding like we're saying the same thing, this is a situation where you want to talk to a lender about your specific situation and how close you are. But if your plan is to come here and then find a job, you're not going to be able to qualify for financing using income for a job that doesn't yet exist. You're going to have to get that financing. Now, if you have a transfer or if you have an employer that says, hey, St. Rick can work remotely, no worries, even though he's going 10 states away, we'll keep paying him the same amount. Those things can work. And maybe if you have a great relationship with your employer, they'll do that for you in the short run while you look for new local employment.
Good stuff. I don't understand this question, Josh. Maybe you can help me with it. How do you guys feel about subject to properties? Subject to? Like buying subject.
Subject to the existing financing. I've done it. It can be awesome. Here's the problem: is the property was bought for $200,000 and has a 3% interest rate on it, and someone wants to sell it to you for $600,000. Where's the other $400,000 coming from? The subject to stuff that we did as investors, it would work similarly. We did one. I won't say what type of underlying financing it was because you're not supposed to do this. But there was a loan on the property for $200,000, and we were buying the home for like $290,000. We wrote them a $90,000 check. We assumed the property subject to the underlying $200,000 loan. We had shown our track record to the sellers so that they knew we were going to fix it up in 60 days, put it on the market, and in 120 days, the underlying loan was going to be paid off. If you're taking a property over subject to existing financing in the current market, if I'm a seller, there's no world in which I would do that because my credit is on the line. You can do it if we want to really bore people here. You can do it with an all-inclusive trust deed, and then they make the payment to you, and you make the underlying payment. But if that new buyer doesn't make the monthly payment to you, you're still on the hook for paying the underlying loan. So there's some fun and interesting 1970s old school real
I'm
estate
completely
tricks.
stumped. I don't even know what we're talking about right now. So
You got to go
seriously,
old school.
I'm not even being funny. I'm being dead
no
serious.
one no one has done any of this stuff since the late 70s, early 80s. There are some investors that know this stuff, and there's ways to make it work, but for the most part it just doesn't apply to the modern mortgage world. The risk isn't worth it to the seller.
Good, good, good. Let's see here. This is an easy one. Madrill says, watching this, the start of the show, just catching up. If I'm in escrow right now, just finishing the underwriting, should I lock now, or is the next few days okay to wait? So, we recommend if you like the rate today, lock it. Don't. There's so much volatility in the market. If you're comfortable, just lock it and move on and stop looking. That's the best advice we can give you. You just don't know where the market's headed. So, but
Take
go
the
back and
stress
watch the
out of it.
first 15 minutes. It goes into detail there. And Josh gives a lot of explanation on why we're talking about that. Let's see here.
Jeb, we got the
Yep.
best suggestion. So keep your finger on that one so you can bring it back. But we have the best suggestion
Right.
for next week's guest.
Get reventure. Laughing my effing a off. Yes, that
Get
would be
him in
funny.
here so he can tell everyone, don't buy a house. It's all going to crash. Just pay me money to tell you this.
Yeah, that's not really what I want to support here on this channel, unfortunately, guys. I don't watch his videos. I don't I have watched one and the data was so misrepresented that I couldn't watch another, and therefore I've never been back. So that's that. Let's see.
All right, shoot
So
down our idea.
there's not really any chance of that happening at the moment. I'd be happy to go on and talk real estate. I just don't want to talk doom and gloom because I don't believe in it, and I don't know that would be that wouldn't do well on his channel. I don't believe.
Yeah.
How would you recommend finding a realtor in the area you don't reside in? So one, if you don't know anybody there to get a referral, good place, do an online search, right? I mean, we've actually talked about this on the podcast too. Do an online search and, try to find the market that you're looking in. Look at Google reviews. You got to go more granular. Don't just read, the guy with the most Google reviews. Go actually through them and read them and whatever, and maybe find a couple people that look like somebody that you'd want to work with, and go deeper on that level. That's one approach. One is try to get a referral. If you have an agent in the state that you're in now or know an agent, a lot of times many times agents network with other agents in different states. I network with agents all across the country a couple times a year. In fact, the next one is going to be May here in San Diego. I do it every year, same conference, and I do one in August and one in February typically. So there's 3 times a year. I meet with a lot of the same people. And that's not even counting the Zooms and all the other stuff that we do where we talk about markets and all that good stuff. So a lot of times we know agents in other states that do business the way that we do, that do, positive experiences, all that good stuff. So find an agent that you know locally and have them hopefully make a referral to that. And then, or if you don't have that, reach out to me. I'll make the referral. But what I'm getting at here, you've got those names that you looked at online. You've got the referral that I'm sending you or whoever's sending you. Now have a couple conversations, see who you mesh with, see who you don't, and go from there, right? I often have conversations with buyers where we just don't mesh for one reason or another, right? I'm very pragmatic. I'm very just to the point. I'm very much this. People want the guy that's going to, weep on your shoulder and all of that. I'm not the guy. So it's not always going to work out with the person that you talk to. So, but to each his own. But just make sure whoever it is, it's a pro. With that said, I'll put a link. There's actually one in the description of the video. If you click on that, you can get connected there too. So Josh, this is one. This is so offer just got accepted for a property in the Bay Area. Appraisal came back 5% under the sales price. Do I have any negotiation power if I waive the appraisal contingency? Tough. Probably not. This is one of those. So I recently sold a property here in in Orange County. Offer was 1.1. It appraised for $1 million. So it was $100,000 short. And in that case, that's more than your 5%. That's what's the math? Probably 8% lower than the offer price. They waived the appraisal contingency. They move forward. In fact, it's closing any day now. So in that case, they didn't even try to negotiate. If they had, could we have done something? Potentially. I mean, because the buyers are already, the sellers are already vested in the process. They're ready to get it done. Had they come back and asked for something off, I could have brought it to the seller. The seller might have done it. So I would say it's worth trying. It's worth having the conversation. You're never going to know unless you ask. So you might go back and say, hey, listen, it came in 5%. I did waive the appraisal contingency, but I'd like to see if you'd be willing to do anything, because the reality is you could probably back out for something else and they could have no leg to stand on. So it's not that you went in with the intent in doing it, but you've probably got, some room for negotiation, just depending on how much, and they might come back and say no, and then you've got to deal with it. So it's worth a try. Always worth a try. Your agent should 100% be recommending trying it, if nothing else.
Jeb, we got one here that comes up a lot in the current market.
Yep.
Andy Rue says, at what point would it not be worth it if I'm trying to get rid of my PMI, assuming rates go higher? Currently, my PMI is 350 a month. My interest rate is 3 1/8. So let's say rates are, if not all the way there, close to 1% higher than where you're at. I highly doubt your mortgage insurance. You didn't quote your mortgage insurance rate there, but at 350, that's $400 or $4,200 a year. So you probably have a fairly big loan, 500,000-600,000, to have that big of monthly mortgage insurance. So it's unlikely to make sense in the current market. What you want to look at is, we talk about this all the time. When does it make sense? Take $125,000, divide it by your loan amount, and that will tell you how much you need to save. So on a $500,000 loan, 125,000 divided by 500,000 tells us we need to save 1/4%. In this situation, the MI doesn't really complicate it. You just need to figure out your MI percentage, take your interest rate plus your MI percentage. So let's say that you're at like 3.8 combined. You'd have to get down to about 3.55 before it made sense on a $500,000 loan. So we just need some more information there to tell you for sure. I would be highly surprised if it made sense for you to do in the current market.
So with that said, I'm actually posting a video on Friday about refinancing, the process of refinancing, when, why you should consider refinancing. Even the environment we're in right now, it still might make sense to consider refinancing. So video will be posted on Friday. Check it out if you want more, details on that refinancing process. I go through a lot of these questions, the common questions that people ask during that too. So it's a good place to start if you're considering it. But again, it's that time where I'm asking for a thumbs up, a like if you're finding any value here. If you've been here with us the entire time and you haven't hit it, there's 260 people on here and there's a measly 92 likes. So there's a lot of slackers in the room at the moment. And I'm talking to you. Yeah, you. Yes. Hit that like button. It helps. And I do appreciate it. So I'm not just saying that. I actually do.
Not
So
only
with that said,
slackers, Jeb, we're 50 light this week. It's usually about 310, 320 by this time in the show. There must be a good game or something on. People are out finding things more entertaining than two dudes talking about mortgage and real estate.
it is amazing that actually anybody shows up, quite frankly. We've been doing this for over a year now, and people still surprisingly show up every single week. So, hey, I'm grateful that we have an audience to talk to. So thank you guys. If it's not just you and I here talking, that's what the podcast is actually. So you can tune into that and hit those as well. And get more.
We didn't get enough of the two of us talking, so we decided we would just get together on our own and talk some more.
Good stuff. I saw a good question here. Okay, so Patrick says, do you think less desirable areas will have a harder time holding on to the massive appreciation than homes located in more desirable areas in the event of a downturn or even more of a sideways in the market? Absolutely, yes. We could go into detail about that, but the easy answer is yes, absolutely. Every single time it happens. There's historically that's proven to be true, and it will continue to be true.
So, Jeb,
But the question is what determines a desirable area?
bingo.
That to each his own, right? I mean, some people, like for example, here locally, we live by the coast in Huntington Beach, right? So we're close to the ocean, and so people would say a less desirable area might be Palm Springs or Riverside County or whatever. But to some people are like, Riverside County is great because I get way more home for less money. So for those people, it is desirable. So to each his own in that situation. But what we've seen in the past is people tend to migrate to these quote unquote less desirable areas as the desirable areas become more expensive. And as you know, the market does normalize and what have you, the very first markets that we see uh, get hit first are the areas that are further away from the markets where people wanted to be initially but just couldn't afford for one reason or another. So again, it's to each his own. We don't know going forward because of migration patterns and all of this stuff if it's going to affect real estate and fluctuations when the market does correct at some point. But I think the answer is yes.
Jeb,
Yep.
thinking California centric here, like you said, coastal is most desirable. The further you go inland is less desirable. I've told you I have an awesome heat map that showed over time from the 80s through the late 2000s how that worked. So less desirable meaning more inland, like for us, absolutely, because there's nothing that can change that from being more inland. But let's look at areas, probably the easy one for everyone to understand. There was a time not too long ago when no one wanted to live in Brooklyn. Now all the cool kids live in Brooklyn. So if we have a downturn, no one's going to go, oh, Brooklyn sucks, let's get out of here. It completely redeveloped and turned over. We have areas like that in Los Angeles County. Silver Lake was awful for a long time, and then prices went up, and all the cool kids wanted to go to Silver Lake. So when you have a situation like that where more urban areas that are built out and they're running out of affordable areas, some of the cheaper areas will gentrify and they'll get nicer and they'll get more expensive and they're never going back. They'll drop the same as the rest of the New York City area does or the LA area does. But things that are geographically less desirable further out, unless things like industry and jobs pop up around those areas so people don't have to commute back to the economic centers, they'll always do worse in a downturn.
There you go. Well said. Let's see what we've got here. Got a lot of comments. I'm looking for some questions. Eddie is asking, can I get a loan to buy land and put a prefab on it? The answer is probably yes. Buying land here locally and getting a loan for it is we don't really deal with, well, I don't deal with loans at all, but even when I did back in the financing days, didn't deal with buying land because there's none to really for anyone to buy. So I just know you need a larger down payment with some of those. Typically, you probably want to deal with your local bank and that sort of thing. Farmers and merchants and that sort of thing here in California does some of that stuff. It's a tough one for me to answer. I think the answer is yes to the question. I just don't know the details of how to get you there.
Yeah, it's going to be a construction type loan, which exactly as Jeb said, bigger down payment, tighter underwriting requirements, but you should be able to do it. And depending on what you mean by prefab, I got excited. I saw some cool prefab stuff online, and then I ran through their little calculator and ended up about $900 a square foot. I said, well, the prefab's not really saving me any money.
Yeah, exactly. No, that's the thing is like, yeah, I mean, to put some of these prefabs on it, you're basically paying what it would cost to build a house. It doesn't make a lot of sense.
Yep.
Let's see. So Justine's asking another question. Is there a correction coming in the future? I don't necessarily think a housing crash is coming, but if said correction does happen, will it level out prices even in hot locations in SoCal? So the macro answer to that question is, yes, it would, but it's going to go down to real estate is local, right? I mean, we've talked multiple times about where inventory is here and locally in Orange County, where I am. This year, right now, we have I came on the show, 1,329 active homes on the market. Traditionally, this time of year, we have about 2,500 homes on the market. Or not traditionally, I'm sorry. Last year, we had about 2,500 homes on the market. So we're about half of what we had last year on the market. But the 3 years prior to the pandemic, 27 through 2019, we had about I think it was 4,000, 3,900 or 4,000, somewhere in that ballpark, number of homes on the market. So we're about a quarter of what we would have prior to the pandemic. And that time, homes were still moving sideways to up. Homes weren't leveling off. In fact, in the video that I posted on Monday, I went into that in in a little bit more detail and showed you the graphs of what home prices were doing during that time. And so to answer the question is a correction coming? Yes, at some point, yes, it is coming in the future. What does that mean? No idea. How's it going to affect real estate? No idea, right? We don't know because we are so far from what is normal at the moment. As somebody that's been in and around real estate for 20 years, everything I've learned as a real estate agent has essentially gone out the door over the last 18 months with regards to how you price a home, what offer you should put in a home, how you should approach different things. It's different now. And so we've got to figure out what are the millennials coming in to the market, the prime buying age millennials doing? Are they able to still qualify for properties? Are move up buyers still wanting to move? Are move down buyers still wanting to move? Are investors still wanting to buy property with prices this high? Pension funds, out of country buyers, like these things we don't know because this is uncharted territory. So, Josh, you want to jump on this? I mean, we talk about this all the time, and there's not an easy answer. We do think a correction is needed, is necessary, and at some point you'll see one, but it's your crystal ball looks a lot like mine.
Yeah, and it comes back to supply and demand and the concept of willing and able demand. When you run out of enough able demand, plenty of people want to own their home. When people get to a certain stage and age of their life, they want to own a home. But if you just can't afford in your area, you're not going to buy. So that's a decrease in demand and a price will correct. And Justine, I think you asked the question exactly correctly. We've gone through before why there's no crash coming, but at some point there could be a correction, and what that correction looks like will largely be dependent on how much higher it goes. We talked in the fall that our hope was we'd be in single digit appreciation this year, and so far through 2 months we're way beyond that.
Well, let's take a minute here and talk about Bruce Norris, right? So one of your mentors that you follow basically says he looks at SoCal real estate or Orange County real estate and says at the current levels, we're essentially at a 4% rate, we're 7% over market value based on current levels or something along those lines?
Overvalued based off of numbers that he's tracked back all the way to like the 70s that say where can affordability go based off of incomes, interest rates, home prices. So
But
rates
what does he say the future looks like though? I just want you to get, not
yeah.
cutting you off, but I want you to get to that too.
Yeah, no crash. It's likely to bounce sideways because again, the reason why he says that, what has led to drops in home prices. So in Southern California, we've had 3 major corrections since the 70s and 1 crash in 2008, 2007, 2008. All of the 3 prior corrections were indicated, or one of the indicators were that we had 30 to 40% of the available homes in the MLS were bank-owned properties. In the massive downturn in 2008, that was 70 to 80% of the homes in the MLS were bank-owned properties. The thing to know about bank-owned properties, banks aren't in the business to own properties. They will sell at whatever the market says they are worth. So to see a crash, a major correction in prices, you have to see a large amount of bank-owned properties come onto the market. And we are seeing people sitting on record levels of equity, relatively low interest rates, incredibly well underwritten loans. So because of that, we are unlikely to have a large volume of bank-owned properties. It would be stunning to see 10% of the market being bank-owned. I could see it, but even at 10, 15, 20%, that tells us it's a much milder downturn than what we saw in the late 80s, early 90s. We had 2 little blips there that were like a year and a half with a 10, 15% correction to the market. So it certainly could happen, and it will at some point, and that's why we all got to kind of hope things moderate. The longer things keep going up at this rate, the more likely it is to be a bigger correction going forward. As long as you get in early enough, it's not something you're super worried about. But the question is, where does the dance end, so to speak?
The dance never ends, bro. The dance just takes a break for a little bit. And I think that's important to know too, is that, if you're in it for the long term, who cares what home prices do next year or the year after? If you can afford the payment, got the longer term view, it doesn't matter. I mean, we saw the biggest crash we've ever seen in history in 2008, right? Those home prices, if you bought in 2006, you pretty much bought at the high. I know that because I did. And those homes took about 10, 11 years to come back to what they were worth. So when Josh and I talk about having a 7, 5, 7, 10 year time horizon, it's not because we think a crash is coming. It's in case something happens globally, a black swan event, something that you're not prepared for, you have time on your side. Now, you never know what's going to happen in life where you have to make moves and adjustments and all of this stuff. But the reality is, if you got time, you're going to be fine in real estate. Look at where your grandparents purchased property versus where it is today. I often go on a listing appointment and talk to the seller, and they'll say, I bought this property for $19,000 here in Huntington Beach. I'm like, wow, 19 grand back in like early 60s. Guess what? Those properties today, $1.5 million, $1.6 million, $2 million, some of these things. Guess what? Time is on your side. You're good to go. So I'm getting off the soapbox now and getting back to questions, but I think it's important. People today, I sound like the old guy. People today, just want to look at what the value is today. And every day they want to look at the value of their home. What's it worth today? What's it worth today? Oh, it went down. Oh God, what am I going to do? No, buy the house, be comfortable with the payment, live your life. And then hopefully when you get to the point where you can sell it or take equity out and buy something else, you've done well, by paying down the principal, by appreciation, by whatever it is that your goals were. Right? If you look at the day to day, you're going to drive yourself crazy.
Jeb, something that you and I have been batting around and talking about here recently is we talk about real estate builds wealth, but if the only real estate you own is your home, which most Americans, 65% will end up owning, probably 90% of them never own another piece of real estate. It's not really wealth, it's more financial security. Because for it to be wealth, you have to borrow against it, which when you get old enough, you can do a reverse mortgage and borrow against it without making payments, or you have to sell it to realize that gain or that wealth. So really what we're talking about is financial security, financial freedom, and fixing your housing cost. I mean, you're still going to have the variable portions. Insurance is going to get more expensive over time. Property taxes are going to get more expensive over time. But if you can buy somewhere between age 30 and 40, don't be crazy. Work on paying it off. Don't borrow a bunch against it. Keep it well maintained. Our goal is to arrive at retirement with a free and clear home or a home with a little tiny mortgage on it. And if you didn't save as well as you had hoped in other places, now you can get a reverse mortgage to monetize it. It's really a tool for financial freedom and security. So that's another reason for that longer term time horizon. I don't know if I've ever told the story here on the show, but one of my wife's best friends, we helped her parents buy. They had been renters for 15 years. They had spent over $275,000 in rent. And in 2006, they decided they finally wanted to buy a house. We talked to them. It's risky. We're at a high point in the market. We see a lot of these crazy loans. I was watching Bruce Norris at that time. He's saying that we're way overvalued. Something is coming down the pike. They said, we don't care. We've been in our house for 15 years paying someone else's rent. We're going to buy this house. We're going to be there for the next 30 years, and we're going to pay our own mortgage. Sure enough, they bought. Sure enough, that thing dropped 50% in value. And
Yeah, it
sure
did.
enough, they did not care. They both had good jobs, made their payments every month, and now the home is worth twice what they paid for it, and they owe 50% of what they paid for it 12 years ago, probably 60% of what they originally borrowed. So again, time heals all wounds. I know over time that real estate is going to be more expensive. If you ask me what real estate prices are going to look like in 3 years, I don't know. If you ask me what they're going to look like in 10 years, I know they're going to be more expensive than they are today.
There you go. Good stuff. So Josh, this is something that we've never talked about. I know for certain on here, and I want to take a minute. There's not a lot of questions and we got some time. What are the biggest mistakes you see for someone looking to buy a home? And I'll start it because I've heard you say this and I've heard other people say it, and maybe it'll lead you to think of some things. But car payments, people going out and financing, leasing car. And I'm not Dave Ramsey. Let me be clear here. I don't think you need to take the Dave Ramsey approach where you can only spend 25% of your income on your mortgage and that you have to go buy a used car in cash and you shouldn't have any debt. I don't believe that at all. I think there's definitely a place for leverage, but I've heard you say it multiple times. People have car payments that are just, obscenely high, and trying to get qualified with a car payment that, is $1,500 a month so that they can drive the fancy car. So you look like you're looking for something.
I'm looking in my notes here because I have a client who I am not going to name here, but we're going through the numbers. How much money did they make? Looks like they made $7,600 a month. I'm like, okay, cool. I think where they're looking, that price range is going to work. And we look and they have $1,450 of car payments. And we're like, well, that's the end of the discussion. You don't qualify. I mean, they qualify, but they're probably 100,000 below where they otherwise would be. Now, do they need cars? Yeah, they probably do. We live in Southern California. It's not an area where you jump on the bus and get where you're going, but they could have two $400 payments instead of two $700-something payments. And you're just looking like, why? Why? Who are you trying to impress? Going back to your apartment with two cool cars? I don't know. I don't know. So again, I'm with you.
Well,
Dave
I don't want to
Ramsey.
sit here and rag on people, but let's what other mistakes do you see people make outside of the potential high car payments, like when trying to qualify for a mortgage? Is there anything on
Just
credit that shows up that's
nothing all that crazy. Just it is important to understand your credit utilization. So sometimes we'll have people that come through, they have one credit card and that credit card is at 80% of its limit. And so it's making a 30, 40, 50 point hit to their credit score. So maybe they're a 690 instead of a 750. Whereas there's a couple of options to solve that. You can call your credit company and say, hey, can I get a higher limit? Now, don't go and spend 80% of the new higher limit. Make sure that when we double the limit, we're now at 40% of our usage. Or get a couple of other cards and spread that balance out so your usage is at 30 to 40% of the limits on the cards instead of keeping one maxed. I can almost always say anytime you see like a lending club loan or something along those lines, it's someone whose financial house is not in order enough to buy a home. There's exceptions to that. I've had people there's one big lending club loan. They said I had a bunch of crazy debt, so I consolidated it for $42,000 with lending club. I've been paying it aggressively. It's down to $22,000, and I'll get it paid off. Okay, cool. The person that has two from lending club, I forget what the other lenders are in that space, but they'll have 4 or 5 different ones for $7,000 or $8,000, and you see the big payments, and you're like, you're never going to get ahead. So it really is, at risk of sounding Dave Ramsey-esque, get a budget, live within your means, know where you're at. And I say that, I've got a client that I just talked to today. They're looking at moving up and buying a new home, makes good money, makes $250,000, $275,000, and yet they always have new crazy debt every time I talk to them. So this isn't, people that make $70,000 have this issue. People that make $275,000 have this issue. Know what is reasonable to spend for your income. Know what your income trajectory looks like. A lot of times we talk to young kids, they just got out of college and the student loans are fairly large, but we want to know that they have a plan for it. Are they in an income-based repayment and going to have public servant loan forgiveness? Just whatever you have, make sure you have a plan, and it's not just, hey, I had to have this and this was the only way I could do it, and so now I'm sort of upside down in terms of what my debt to income ratio looks like. But those would be the big ones, Jeb.
good stuff? Jeep Rider here has got a good question. First time home buyer, been pre-approved, have a realtor. How involved should the realtor be? I know the decision is mine, but getting no help on finding a property, searching for 4 months, is that normal? So let's look at this, right? Because I'm guilty of this as well. As a real estate agent that has a lot of buyers, there's not a lot of inventory at the moment, right? So, you know, it's difficult for is for agents. I mean, again, I'll say real estate's local, so depending on where you are, there might be a lot of inventory, and your agent's not doing anything. Here in Southern California, there's just not a lot of inventory, so it looks like I'm not doing anything because I'm not following up on properties every single day with clients. But there's just very little that matches what people are looking for in many ways, and in many ways, I know what things are likely going to sell for far and above what their budget is, and so it's a catch 22. It's hard to say, whether or not I'm my skills are negotiating. My skills are helping you get the most amount of money for your house, or helping you get the best deal for that property once we're in escrow, helping you negotiate repairs. That's my expertise. Me looking at the MLS every day, sending you a property that may or may not match what you're looking for, based on certain factors. I mean, the information is so, what's the right word? It's at your hands these days, right? You have access to as much information on finding property as I do in many ways. And because of the lack of supply, you could probably go through it a lot quicker and figure out properties that may or may not match it. Where I come in is, hey, is that property in a good location? Is it valued correctly? That sort of thing. So just understand, if your realtor's not sending you property, it's not that they're not doing their job or using their expertise. Maybe you haven't tapped into their expertise yet because of the environment that you're in. Now, if you're looking for an agent that is going to hold your hand and send you properties versus you having to look for them, then that's a conversation you need to have with the real estate agent. And if that agent knows that and is not doing it, then find a new agent. I mean, if you came to me and said, Jeb, I want you to send me property every day and follow up on all of them and have that conversation, I'll set you up on a search. But I'm not going to I'll be honest, I'm not going to follow up with you every day on every property. If you see something that piques your interest, let's have a conversation. But I'm not going to be the agent that does that. And that's just how I run my business. As I said, my expertise is in other areas. So you've got to find the agent that serves you the way you want to be served. And maybe that person may or may not fit that. And that's okay. Just understand that as long as everybody knows what you want and you've had the conversation, then you make the decision. But if you haven't had the conversation about what you're looking for or your expectations, then it's hard to figure out whether or not they're doing their job. So hopefully that provides a little value and clarity on that question.
Jeb, we have a super chat that we missed, and it's
We
it's almost a repeat of another question. Oscar Romo says, bought my house in July at 2.875 with an FHA loan. I want to refinance to drop my PMI, but with rates soaring, not sure what to do. What do you recommend? Well, if we bought in July, it's possible. I mean, we're seeing 15 to 20% year over year increase. We're only 7 or 8 months into it. So the first question is the value there to get rid of the mortgage insurance? The second is there a financial benefit in doing it? So with FHA, we know what the mortgage insurance is. So it's 2.875 plus 0.85 is the mortgage insurance rate. It's at 3.725. You would have a very hard time finding that interest rate without paying some points right now. So don't recommend it. We definitely think there's going to be an opportunity 1, 2, 3 years in the future, and the value should be there at that point in time. Financially, I don't think it would pencil out for you running the numbers. So sorry it took a little while after the super chat to get back to you.
Yeah, I realized I
definitely
didn't miss
appreciate
it,
it.
so I apologize. I will give that money to a starving child in
To an
my family.
805 drinker.
Yeah, to a starving child in my family who eats snacks constantly. It'll go towards snacks. How's that? I buy a lot of snacks.
South Jersey Matt pointed out why viewership is down. The Sixers are on.
Oh, that's it, huh? So we got a lot of Philly fans in here.
They got James Harden now, so they're actually going to pay attention.
Ah, look at that. Sixers are on.
Oh, yeah. He follows up Embiid and Harden. We already had Embiid. Now you got Harden until he tweaks his leg or decides he wants to be on another team.
All right. Let's see. We've got what point are we in the show? 141. Let's see. We're at 154 on the likes. I'll ask that you guys hit it one more time. So hit the thumbs up if you're finding any value. We appreciate it. I'll also plug the podcast that Josh and I started. I'm wearing a shirt, The Educated Homebuyer. Is it tilted that way? There we go. Boom. Boom. Check it out. Go in depth on all things real estate. So check that out on any platform that you listen to podcasts. I'd actually like to know if you listen to podcasts. That's probably something I should put a survey out there for. How many of you listen to podcasts that are actually on YouTube, or do you prefer to see the person's face? Prefer to see this beard? What do you think about it? You guys think about the beard? Should it go? Me and my wife. Oh, how's this? Why we got a down moment? So my wife and I made a bet. It was supposed to happen last night. Sidetrack. It didn't happen. So next Tuesday. So every Tuesday we have date night. So next Tuesday, hopefully it'll go down. We have a bet. Her bet is if she wins, we're bowling. I'm going to crush her, by the way. She has no idea. I'm just going to get crushed. But if she wins, I've agreed to glitter my beard. So she sent me a picture of this guy that had a pink glitter. I hate glitter more than anything in the world. So I agreed to glitter my beard and actually come on here and do a live show with the glitter of my beard. Josh isn't going to be here next week, so he could miss this opportunity
The glitter beard.
to see the glitter. And there, that's another reason I can't shave it, because I'm agreeing to this. But if she loses, here's where the glory happens. This is I'm confident I'm not losing, so I'm willing to make this bet. This is glorious. She has to wear a Masters. If you guys watch the Masters, the jumpsuit, the white jumpsuit with my name on the back, and she has to caddy for me at the golf course, and she has to caddy my clubs. She has to carry them on her back, and we're going to go up to hole one. I'm going to ask her for my clubs. She has to clean them, do the whole thing, playing with my normal foursome, and we're going to go out and we're going to be on the busiest day. It's going to be fantastic. We'll get a camera crew to follow us around. Maybe we'll live YouTube stream. We'll stream it on YouTube. Anyhow, that's where we're going, in case you guys are wondering what's happening in my world. Your beard, your decision. Oh boy, there we go. We're there, huh? Your beard, your decision.
Don't bring politics into this.
Is that politics?
Your body, your choice, Jeb.
I thought that was like a movement, not a politic. But hey, do realtors get alerts on MLS for criteria for clients? Yeah, it depends on if. Yes, we do. And do you have it set up to send you an email? So I have my clients on emails where they get the property. Some of them, if it's super something super specific, I'll make sure I send myself on the email too if I'm not monitoring that sort of thing on a daily basis. But I do have the ability to see what they see every single day. So the answer is yes and no, depending on how it's set up. Josh, got somebody here asking about USDA loans. If we looked at USDA, we looked at conventional, we looked at FHA, right? We're going to take VA out of it, because VA, if VA is an option in there, VA is the better of the loans, depending on the scenario and whatever. But most people don't have access to those, only for veterans, those who've served in the military and met certain guidelines. But outside of the three, what would you say the better of the option is, depending on, I mean, if you got 20% down, then probably conventional. But if not, then let's talk USDA just for a minute.
So let's make it simpler. If they're asking about USDA, they probably don't have a bunch of money to put down. So let's say you're looking at limited finances to put down. So you have minimum down options: 3% conventional, 3.5% FHA, 0% USDA. USDA is probably the best option. With USDA, you have income limits, but it doesn't sound like income limits would be an issue for you. You don't have to put money down. And if the property appraises for more than what you agree to pay for it, probably a crazy thought in the current market, but if it did, you can actually borrow to the appraised value and cover your closing costs and get in with nothing out of pocket. You can also get lender credits on it and get in with nothing out of pocket. So it's a really good loan program. FHA requires 3.5% down, and it has mortgage insurance. So assuming you qualify for both, assuming the property is eligible for both, you would always do USDA over FHA. Conventional, you're probably looking at the same thing: 3% down versus 0% down. You're going to have probably higher mortgage insurance, but just compare those numbers. You want to do a side-by-side comparison. We talk about numbers never lie. I'm just telling you off the top of my head, if you were eligible for all three, the property qualified for all three, you're probably going to like USDA best. And when we say that, what do we mean? What are we talking about? What do buyers care about? How much money do I have to come out of my pocket with to get in? What's my monthly payment? And then in this situation, we always want to ask, what's my loan amount? because even though on FHA you're putting 3.5% down, there's a 1.75% upfront mortgage insurance premium that gets added on to the loan. So you have less equity in that property than you put down on it. So when you pencil them out and look at them side by side, you're probably going to like the USDA best, just based off the combination of interest rate, mortgage insurance, zero money out of pocket, or zero down at least.
Good stuff. Freedom Seeker says, sold my house last July, got priced out basically. I could have bought homes, but none of them were as nice as what I had for a comparable price, and then inventory got low. So I bring this statement up because I'm often having this conversation with potential sellers or potential people even thinking about selling. You got to have a plan. And if your plan is to rent and you're okay renting, then it's great. But just make sure there are rentals out there that are in your price point, which I'm going to click on a comment here in a minute that's going to discuss rentals. But just, if you're selling and planning on buying something, know what's out there, know the inventory. There's ways to structure it where you're not homeless or don't have a house to move into, and so on and so forth. But it's a market where things are moving aggressively. I have clients that sold back in 2019 that are still renters because they got priced out of the market and they kept thinking the market was going to pull back and pull back. Here we are 3 years later, they still don't own a home, and chances are they probably won't because of the direction that the market has moved. So just have a plan regardless of what that is, and know, potential pitfalls of whichever direction you decide to go.
Jeb, it's not an
Yep.
uncommon question. We got another one here. If I sell my house, will I get priced out of the market due to inflation, low inventory, and a broken supply chain? It's a definite possibility. Like if you tell me you don't own a home and you say, I'm not comfortable buying in, I think prices are going to come down, it's a wager and you're not risking nearly as much. But if you're in the market right now and you step out of it, not only do you have the opportunity cost of not getting into a home, you have the actual cost of the appreciation you would have had on your residence. I mean, you would have to be spectacularly good to know that there's something about the current moment that makes it the time to sell a home and step out of the market. But in this instance, Lion Eyes is asking, it can be hard to get in. I mean, Jeb, that's one of the questions people always ask. How do I negotiate this process of selling and buying? It's a risk to just sell without having a home, even with the 60-day rent back or contingent upon getting something else in the contract. It's hard to get a contingent offer accepted. You want to talk about that?
Yeah, and a good point. I mean, what I see in this market is people willing to buy property with the idea that the seller needs to find a replacement property because there's so few options out there. Sellers are like, I'll do whatever I can to secure a property and secure a price, even if it takes you 2 months, 3 months to find a property. At least I'm in escrow and I don't have to do this anymore. And there's a risk that falls out and you still don't become a home buyer and you still have to start looking, but at least you have something in contract. And that doesn't mean you can't continue to look while you're under contract on that property as a buyer. So just understand there's some pros and cons to doing it, no doubt. Now, Josh mentioned, what did you mention? I completely thought I lost my train of thought as soon as I said that.
It's a long time ago, bro. I
Oh,
can't remember that.
oh man, you ask about selling and buying in this environment and the risk.
Contingent offers.
Yeah, so contingent offers, on the sell side, it might be a little bit more difficult to get your offer accepted, but if you're in escrow, at least you've got a much better leg to stand on, especially if the buyer has done all their due diligence on the property and all they're waiting for is you to sign off on finding a replacement property. You're probably pretty golden. I definitely think that's a possibility in this environment, even where we are with regards to inventory, you can still get that done. So just know what you're up against in those situations. Wow, I really had a loss there. But there was a good question here I wanted to get to that. What was her name?
While you're
Elizabeth?
looking for that, let
Elizabeth?
me let
Elizabeth?
me throw let
Jasmine.
me.
Hold on, one more.
You got it.
Yep, I got it. Hold on. Jasmine, I'm on the property manager side, noticing that rental rates are slowly going down. I'm thinking that's probably due to the interest rates going up. Do you see a slowdown in the housing market? I haven't seen one. Rentals here locally where we are still very much in dire need. I mean, we have very low supply. We got a lot of buyer demand. And we're coming up on the time of year where rentals are going to rent quickly anyway because we're close to the beach. It's going to be summer. People are wanting to get in, to be here for summer and that sort of thing. So I haven't seen any reflection of lowering rents or that affecting housing here where I am. Now, if you tell me you're in Huntington and you're seeing that, then obviously I'm missing something. But I haven't at this time.
Well,
And Josh,
Jeb,
you just rented a
we
property out.
rented
Yeah.
two properties in the last 6 months. We had a unit in my fourplex in Long Beach, 2 bedroom, 1 bath, 700 square feet. Um, a shockingly high rent. And that one, it took a while to find the right tenant. We had lots of people wanting to rent it at the rate we were paying, not ones or rate we were asking, not ones that I was confident would actually be making the payment every first of the month. So it took us about 45 days to find someone that we loved, but the number was astounding. Same thing with the property in Orange, probably $300 higher than what I thought it would be when we bought the property, with lots of showings, lots of interest, people 10, 15, 20 people inquiring a day. We took it off the market, and I still am getting inquiries. Is this available? I'm like, well, it says it was rented, but no.
Well, with that said, I recently had someone reach out to me and ask me if a 12% increase year over year was normal in their apartment here locally, and or could the landlord do that? And the answer was yes. And so in that one alone, rents had gone up. Now, just like housing, you're going to price people out when if you continue to do that sort of increase. So that's it. It's not sustainable. Just like what we're seeing in the housing market isn't sustainable to grow at those sort of levels. At some point, you're going to see some pullback. The question is that pullback that you've seen in rentals, is it 1%? Is it 2%? Is it just leveling off? I mean, that all that stuff is important. But at the moment, rentals are in high demand. A lot of people selling, need a place to go. A lot of people having to leave the current rental they're in because the rates are going up and they need somewhere to go. So there's a lot of different factors driving demand at the moment.
Jeb, we got one here from a normal viewer, our friend
Mm,
Stephen Yates. Is it
yep.
possible to build equity in a modular house on land you own, or does modular lose value no matter what over time? For those of you that follow and watched here every week, the only property in this category that I'm against is if it's in a park on land that you lease versus
Yes.
land that you own. Owning the land is the most important piece. People, there's two pieces to it. We're here in coastal Southern California. There are parks that are really near the ocean, and there are people that are like, I'm a beach person, I want to be near the beach, and they retire to a property that a modular home, mobile home that they own right next to the ocean, and they wake up 15 years later and now they're 80 years old and it's $3,000 a month space rent. So they haven't built the equity in the property because it's personal property, not real property, and they get priced out of the market. There's a complex here that sold in Huntington Beach, Jeb, over there on Bolsa Chica. It was an astounding number, like
56 million dollars.
$56 million for
Something like
not
that. It
a
might be
big park.
57 or 55, but it's around there. Yeah.
And the
330 something $1,000 per space, I believe is what it
just
came
a
out to.
space for other
Yeah.
people, and you're going to find this hard to believe, but the first thing they did is they informed the tenants
Yep.
there that each of the next 3 years they're getting a $250 a month increase in their
Yep.
space rent. So in three
And
years,
that's a senior
$750
park,
a month.
by the way.
Senior
So
park.
people on fixed incomes, all of that's, it's sad. But it's I mean, unfortunately, that's the reality when you have some big hedge fund basically come in and buy an entire park,
So
you
to
know?
Steven's question on this, why does that matter?
Yeah.
Well, they don't own the land. They own the property, but they don't
Right.
control the cost of their housing. So they're not building up equity. The my house depreciates over time. The land value goes up. So really that what are we looking at? Yeah, the cost to build the homes goes up, so you can say they're not truly depreciating, just because the cost to replace it goes up. But the majority of the increases we're talking about is how much does the land that the house goes on go up? So, Stephen, you're fixing your housing cost by buying that property, and you're building equity in the land, if nothing else. And that modular that you're looking at is a very, very nice property. So I'm not concerned with that.
Good stuff. Jennifer is going to be a homeowner. If you guys didn't hear earlier, she closes on Friday. So everybody say congrats to Jennifer. She's here every week. In fact, she's been here every week for, God, I mean, a year at least. So thank you, Jennifer. Congrats. It's okay if you don't show up next Wednesday after owning a home. We get it. We will need we can't replace you. We need another fill in at some point, right? You can't be here forever owning property. Maybe you can. I don't know. But either way, congrats to you. Josh will not be here next week. I'm looking for guests. You guys gave me a couple names, but you gave me nothing new. I was looking for something new. You gave me Jennifer Beeston, great guest. Jason Walter, also a great guest. I don't know if I've actually had him on a live. You gave me Kyle Seagraves, also a good guest. Who's some people we haven't heard of that you like, that you know, maybe have a connection to? That's who we should have. We should have The Rock on here. My kids would love that. We should have The Rock on talking about mortgages for 2 hours. How good would that be? It would be awful, in fact, because he wouldn't be able to answer any questions. But hey, my kids would like it. That's all that matters.
He could flex.
Exactly. He could do his showdown like at the Super Bowl.
Yeah.
But again, guys, I want to say thank you guys for the support, for being here every week. 2 hours every single week to provide value, to help you through the home buying process, to educate you, guide you, empower you, help you buy right, borrow smart, build wealth, all of that good stuff. That was good, huh? Should get that trademarked or something. Anyway, appreciate you being here. Hit the like button, the thumbs up if you haven't done so already. Josh, what kind of great going away do you want to say? You're going to be gone for 2 weeks, bud.
I'm going to be in the warm Florida sun, learning and having business meetings. So it will not be
what are you going to learn? Fun. What are you going to do? What are you
lots
going
of
to do?
Stuff. It's a mastermind. It's a large mastermind with 300 of the most brilliant mortgage professionals in the country. So
is this Freedom Club?
Yeah.
Okay.
Yep. So we'll come back with some good information for you guys and good information about running our business more efficiently. So for those of you who are kind enough to work with us on your financing, it will go even smoother and faster than before.
Good stuff. One last time, I'll ask if you haven't done so already, thumbs up, that little podcast, little icon in the corner there. Look at that. Look how I plugged that in. I should have done that earlier. The Educated Homebuyer, Spotify, Apple, your favorite podcast platform. Check it out. Listen. Let us know what you think. If you think it sucks, tell us. If you think there's an episode you want to hear, tell us. We go deep dive and all that stuff. But for now, appreciate all the support. See you again next week with a special guest. Surprise.
To be determined.
Yeah, it's going to be a surprise to me as well, guys. Adios.